G'day guys, welcome back to the Devon Too Good Investing channel. In this video today, I'm going to be giving you guys a update on Thor Industries first quarter fiscal year 2023 earnings results. So we're going to be talking about how the company performed and sort of expectations going forward and things to look out for. Pretty much for this video, I've used a bit of a traffic light system where red is bad, yellow is just neutral, green is good. But guys, now that we've got that out the way, let's get right into it. So net sales year over year, it was down 21.5% to 3.1 billion. This is mainly due to end demand weakening due to the economy weakening as well, seeing higher inflation, increased interest rates, less demand for towables, motorized, Thor products. And as a result, of course, gross margin has decreased by 90 basis points. This is expected. If you see that sales have reduced, it's likely that gross margins have reduced as well. This is due to pretty much scales of economy. But luckily, this gross margin decrease isn't too bad due to Thor Industries' variable cost structure, which allows them to reduce capacity, which means they can reduce costs, so the margins don't get hit too bad. However, obviously it's still a decrease, which then led to EPS of $2.53, a decrease of 41.7% year over year. It's a big decrease. However, if you compare their EPS to sort of pre-COVID EPS, it's still pretty good. And you're looking at a company that's trading at about a 10 PE based on these numbers here. If we then have a look at the North American independent dealer inventory of Thor products, you can see that the inventory peaked within this year. However, it is starting to sort of normalize here. I would say it's still high compared to historic levels, and I do expect this number to continue coming down as sort of Thor manage supply into the market and people keep sort of buying Thor products from the independent dealers. This number should continue to decrease, and we can see that the RV backlog has decreased 59%. So Thor has chewed through most of their backlog here, and it's probably still slightly above historic levels. So that's just one thing to take note of. So if we look more specifically at their North American towable segment, this is where sort of demand has weakened a fair bit. We can see a decrease of 41.2% driven by a decrease in unit shipments, partially offset by an increase in average selling price of their products and also a change in product mix. This is, key drivers here. A lot of destocking going on at the independent dealers. The backlog has been chewed through, and just overall lowered demand. We can see gross margin down 330 basis points. Now, if we look at the North American motorized segment, this is actually performing, it actually grew year over year. It grew 21.5% year over year, and this is driven by an increase in unit shipments. This is mainly due to parts that weren't previously available now becoming available. So then that demand is now being filled by Thor as Thor ship their units out to the independent dealers to then sell on to the client. And we can see the gross margin here increased along with net sales. Obviously, scales of economy here. There's a strong order backlog for these motorized vehicles. So if we look now at the European segment, we can see that net sales dropped 20.3% year over year, and this is driven mainly by a decrease in unit shipments. Of course, demand is being pressured over in Europe with all the challenges they're having over in that part of the world. But of course, they're also struggling with supply. They're struggling with semiconductors. They're struggling with chassis. So as a result, that has caused independent dealer inventory levels to remain near historic lows. So, it's hard to tell how much of this is driven by supply constraints and how much is driven by weakening demand. But I'm sure there is, certain amounts of that baked in from both sides. And we can see the gross margin has increased quite considerably here year over year due to an increase in net selling prices, pretty much. In terms of balance sheet, look, Thor does have debt. They are paying down debt. They've got $1.7 billion in debt. But in terms of liquidity, they've got $1.1 billion. Thor are pretty disciplined, and they historically have been disciplined at paying back debt. So this will probably be one of their priorities to sort of bring their debt down to their selected financial ratios here, which is a long-term debt to EBITDA of around 1, and then a long-term debt to adjusted EBITDA of around 1 as well. So in 2023, I think the fact that 85% of the cost of goods sold is variable is really good for this business. So pretty much they can pull back production and pretty much capex costs, which then allow Thor to remain profitable even in tough operating environments like we're seeing at the moment. So this slide here gives us some full year fiscal guidance for 2023. We can see this guidance here is based on the assumption of the RVIA's December 2022 forecast for 2023, and they're expecting shipments of, about 379,000 to 403,000 units. As we discussed, the European shipment volumes are anticipated to remain constrained due to chassis supply. And then, of course, inflation is going to continue to put pressure on the cost of raw materials and also pricing in 2023. They are guiding a capex of 280 million, which I do kind of think is kind of high here. Is it the biggest deal in the world? I don't think so. But it is kind of weird considering that, this capex is larger than last year, I'm pretty sure. Or at least it's much larger than, their capex historically. But I guess they have grown a lot in the last few years. Probably not the end of the world. They're expecting EPS of 7.4 to $8.7 per share in diluted earnings. If you think about where the stock price is trading now and you look at those diluted earnings, it's trading at about a PE ratio of 10, which is below their historic PE ratio of about 16 times. And then gross profit margin, this is lower than what it was last year. They're looking at 14.2 to 14.9%. Well, look, it's still above their bear case scenario that they laid out in their investor presentation a few months back. So it's, obviously they're going into a downturn here, and this is expected. So pretty much, guys, to wrap up the earnings, I'd say that everything here was expected. I did expect a decrease in revenue, did expect a decrease in gross margins. They're using their variable cost structure to remain profitable. They're guiding, you can see the guidance here on the screen for 2023. Look, I'm not looking to buy Thor at this price at the moment. I'm looking to buy Thor at book value, roughly $68 per share. That's my target price. But anyway, guys, thanks for watching. Make sure you like and subscribe, and I'll see you in the next one.